Hi, it's Eric Nuttall of the Ninepoint Energy Strategies. Back from summer break. We hope everybody had a relaxing break and are enjoying kids being back in school. With fall now here, or almost effectively here, there's a real debate raging between the bulls and the bears for the outlook for the oil price over the short term. The bulls would say, look, we have had inventories flat to declining in major areas of the world. The structure of the curves of oil prices suggest tightness, not a weakness. We look at crack spreads being very, very high. And then they say, look, OPEC was supposed to add all this production and their exports just simply aren't matching it. And there is some credence to some of those arguments. The bears at the same time, and we would view ourselves to be somewhat cautious over the very short term, would say, well, look, here's a few things to consider. The first is the headline return of 2.2 million barrels per day from OPEC countries was never expected. We've chronicled this. A lot of data providers that we use to track exports and production, et cetera, would have shown that there was a lot of cheating during the course of the deal amongst the voluntary 8 members. And so while the headline is 2.2 million barrels per day, in reality, it's closer to about 1.1 to 1.2 million barrels per day. Secondly, it is true that exports from OPEC plus countries have lagged the headline number, especially from countries like Saudi Arabia, where August exports were actually lower on a month over month basis when production was supposed to be increasing. We think there's two real reasons behind that, and we think that that is set to change near term. Firstly, in the summertime, the need to burn oil for air conditioning is very, very high in the Middle East, especially in Saudi. I was told they had an especially hot August. And so they were burning as much as 800,000 barrels per day for air conditioning needs. Given that it is now September, that is coming to an end. Secondly, Saudi did increase export slash production in anticipation of a possible actual outage from the US strike on Iran. That never came to pass. And our belief is Saudis, their word is their bond, is their ethos. And so in order to comply with that overproduction in that 1 month time period, the subsequent couple of months were artificially depressed to realign themselves with full compliance because they've been fully compliant with the history of the deal. So as we look to September, we think that exports from Saudi are expected to increase meaningfully. We use firms such as Kepler to track that. And what they can see is there's been a notable increase in the amount of tankers heading to Saudi to receive that oil. They also, as of this morning, if you look at expected exports for the month of September, and it is very early, so this is an early number, they're showing that exports will be up 436,000 barrels per day on a month-over-month basis. So we think some of the narrative around, OPEC exports tracking or lagging production is going to be coming to an end. Secondly, the debate is, well, look at, our global inventories, are our inventories rising or are they actually falling? Globally, as of this morning, what we can show are that inventories were up 147 million barrels per day. So that's globally. Importantly, half of that, about 52%, 77 million barrels, has occurred in China. And so we do think that has been SPR, so Strategic Petroleum Reserve stockpiling, due to a variety of strategic needs or views within China. So the debate is, well, look at, those builds are not happening in OECD countries, it's not happening in Europe, not happening in the United States, and therefore the impact of those builds on price are negligible. As we're entering into the fall time, a few things are changing. First, as we've talked about, we think that OPEC exports are going to start to increase, fully aligning with the roughly 1.2 million barrels per day of actual increases. Secondly, there are a couple non-OPEC countries, namely Brazil and Guyana, with FPSOs that are online now and ramping. So in Guyana, there's one roughly 290,000 barrels per day. We can see that exports are increasing up about 40,000 barrels per day already from that. Secondly, in Brazil, they've got about 400,000 barrels per day of new capacity coming online. X off some of some maintenance for other platforms being down, call it 200,000 barrels per day. So if you look at like between OPEC countries, between Guyana, Brazil, even Canada, production here has been hitting record highs. There's a lot of new oil hitting the market in Q3 and Q4 of 2025. And so we think that China's ability to increase stockpiling is not going to be able to absorb those incremental barrels. And so you will start to see builds in what is called visible areas, such as the United States, et cetera, which today sits at multi-year lows or near multi-year lows. And so our view is, well, that will ultimately hit price in the very short term. The debate is, okay, well, how large are those builds going to be? You can feel the trepidation amongst those calling for 2 million. I've even seen as much as 4 million barrels per day, which we think is nuts. But even a 2 million barrel per day number officially in print from companies like Energy Aspects, you can see in print they're starting to say, well, look, things aren't really adding up for a variety of reasons. So it feels like the level of bearishness might be a little too high, and yet how do we view the likely trajectory over the next couple of months to quarters? We were never one calling for like the 40s or the low 50s, etc. We think reasonably, if you need to offset some of the builds that are projected, you would need that to be impacting U.S. shale production. That's the marginal source of short cycle supply. With the spike earlier this year into the high 60s from geopolitics, the Ukraine, Russia, and Trump talking about, how he doesn't want Europe to buy any Russian barrels, et cetera, all these different things. We do think that shale producers were very, very active in hedging themselves often. So their sensitivity to, let's say, a $60 oil price is not as much as it would have been in the past. So while we've seen the rig count fall off pretty dramatically, continuing still, we think we're now, in the low to mid 60s, we're in an era of plateau production in the United States from lower 48 shale, at least, not declines. And so if we do need declines, which it would view that to be reasonable, we're looking at an oil price anywhere from 55 to 60, somewhere around there. Importantly, though, it's as energy investors, you need to recognize that at some point in, I think, early to mid 2026, the view on oil is going to change dramatically to the positive, and there's a couple of reasons for that. The first off is we think that OPEC spare capacity as of now, so this is September, the full unwind of the voluntary deal, we measure at 2.1 million barrels per day. Global demand today is about 106 million barrels per day. And so our definition of that is, well, that's normalized. That's a very thin safety buffer. There's conversation heading into this weekend when OPEC members will meet again about the unwind of another deal that they struck, which was supposed to go all the way through to the end of 2026. And there's conversation, we're always dubious when something comes out on Reuters, but there are other what we'd view as more credible sources that are indicating that, well, perhaps OPEC members will unwind that deal as well. Should that come to pass, headline negative, but what that would mean is basically OPEC, our interpretation of that action would be that OPEC is not just unwinding, prior deals, but fully unwinding their actual real spare capacity. That's the safety buffer, the shock absorber to any actual supply interruption. That would be a wildly bullish development over the medium term. And a reason why might they do that? In public conversations, you've heard key leadership within OPEC talk about how, countries take for granted the cost to maintain spare capacity. It's enormous. And so if countries or leaders, mainly the president to the south of here, is going to, admonish these countries and berate them for having spare capacity, then why bother, especially when there's other much more important domestic spending priorities. And so that could be the interpretation behind that. We don't know that. That's just kind of reading the tea leaves should that action come to place. And so early to mid 2026, not that far away now, we're effectively in an area where OPEC either has no spare capacity or it's fully normalized. And it's being held effectively by two members. It's really Saudi and the UAE. Secondly, we do think that U.S. shale remains in its twilight. Whether that's a plateau, whether that's a decline, it's kind of moot. The world has effectively lost its largest source of incremental supply over the past decade. And so we're increasingly relying on larger, long cycle projects, these projects such as offshore Brazil, offshore Guyana, maybe one day, a greenfield project in the Canadian oil sands, etc. And because of the importance of U.S. shale on total non-OPEC supply, many people think that the growth rate from non-OPEC is actually going to be peaking around February of next year. And I know peaking has been a dangerous word to use. So losing production growth from, call it 2/3 of global oil suppliers, because as Exxon highlighted this week or last week, the world faces a 15% decline rate. So natural declines of fields, you lose 15% a year. And we know that exploration results peaked well over a decade ago. We know that spending is down dramatically, even on an inflation-adjusted basis. And then thirdly, then what we see is ongoing demand growth. Whether it's a million or 1.2 million, we can debate that. Whether the economy is going to slow or not from the ongoing impacts of tariffs. What we see is a world where the demand for oil will grow longer and stronger than consensus believes. U.S. production, which has been that largest source of incremental supply over the past decade, is no more. As a consequence, non-OPEC countries in aggregate, so that's Canada, U.S., Brazil, Guyana, and others, will be unable to grow their supply. And historically, then the baton would have been passed off to OPEC. But OPEC will have either normalized their spare capacity, 2 million of 106 is razor thin, or even they themselves will have fully depleted that. And so we do see a structural mismatch at some point next year. We just think that there's cause for pause over the very short term in oil, but remain very, very bullish on oil stocks, especially those in Canada, because we do see in a world where there's this mismatch between supply growth and demand growth, where U.S. shale companies are facing an inventory challenge. Canada is going to be the bastion of fund flows for investments. We have the highest quality reserves, arguably in the world, very long duration measured in decades. There was a good report put out by Peters & Co. earlier this week talking about the payback. So that's, you drill a well, how long does it take to get back your investment? And then how long does it take back your investment a second time around? And in I'm cuffing this, roughly been the top 10 plays in North America. Canada has 8 of them. And so we're very, very profitable oil plays. Our companies have delevered significantly. And so we see a strategic value one day being placed on those. For the time being, we prefer natural gas. Unfortunately, of course, when we pivoted to that, we experienced the coolest summer in July and August in the past 10 years. So the gas price has softened off a little from that. What we're seeing now is the strip price for natural gas is roughly $4 per MCF for both 2026 and 2027. At that gas price, natural gas producers are trading at an average 14% free cash flow yield. We see very modest growth, low single-digit growth rates, and so it's this ongoing return of capital in the form of buybacks from those companies. And so we favor natural gas over the very short term. Every time, these days when I wake up, I'm checking a few things. I'm checking, Saudi exports on Kepler. I'm looking at non-OPEC exports. I'm looking at Guyana, Brazil, etc. to try to see, okay, what is the quantum of new volumes hitting the market? How overly bearish are a lot of the forecasts right now? Are there modeling challenges? Will it be 2 million barrels per day? Is it going to be 1 million? And trying to figure, okay, how much of the builds are going to be in so-called observable areas in the world, namely OECD, so namely the United States and Atlantic Basin, what impact that will have on price. And so we're not ultra bearish on price. We just think that there's a few too many uncertainties over the next, call it a couple of months, especially at a time when natural gas stocks just got absolutely lambasted in July and August. They've gone from consensus longs to, I'd say, neutrals at a time when sentiment towards the energy sector remains very, very out of favor. I think investors are chasing shinier objects in tech stocks and Bitcoin and else. And so for a sector that remains out of favor with negative flows for at least the past year and a half, there was a strong exodus from natural gas companies. And so we look at valuations today as being very, very compelling, even just using scrip, even though if we have a normal winter for weather, given the build out in LNG projects, almost 4 BCF a day of new demand, 2026 over 2025, you could rapidly erode the storage surplus in natural gas inventories, leading to a price spike. And so for that, again, we're going to wrap up. That was slightly longer than what we intended, but the first time back from summer, we wish everybody a healthy fall, and we look forward to doing this on a more frequent basis.